Yo. It's like I'm trying to leak something. Hold on. There we go. All right. Now we can't leak anything. Okay, good afternoon, everyone. Today is another day and another dollar. So, posture for today. Let me see something. Okay. Delete that video because that was just leak central. Okay, so today we're gonna keep it kind of simple. We've just been going over the what would I even call it? Yes, the slides for our mentorship program we've been embarking on, and you won't be able to. Oh, you can see it. Nice. Okay. So this is DXY. If you look at the dollar from yesterday to today, you can see that this imbalance we've been trying to fill in for a while. We took out these equal highs over here, but they weren't really equal highs to be fair. But we took out this previous high over here, which was the high or the lower bound of the. Excuse me. The lower bound of the imbalance. Make this a blue for now. Cool. So check out this lower bound here. This upper bound we filled. This is the open. It should really and truly be from the close to the open, right? That's where the gap is. We've gone up and into the gap a little bit, came down. This way we came to create equal lows over here. Then we've just been moving upwards. I thought that price wanted to, DXY wanted to take out these equal lows, but it just hasn't since, and it's just been going up. So we've got the bias wrong essentially for the past couple of weeks. This imbalance here, again, should be from this close to this open, right? And we've just fully fulfilled it, and it looks like the price wants to continue. There is some more imbalance up here. If I was to remove all of the drawings, we've just explained what's happened. Going from here to here, well, actually the throughout is a lot better. This from here to here, we have this strong imbalance right here. So I think price or DXY wants to head into this. So we're bullish on the dollar, right? So we're bullish on the dollar. Okay, let's see. So here, we'll probably just advise it to do this. Well, what do we notice here? So pushing up, had a leg here, pushed up, leg here. Here we took out this low with this, and when we would have pulled back to it, we didn't come lower. We did have this imbalance. Filled that quite quickly, and then should be on the hourly really. And then after this imbalance got filled, we took out this high, came up to this order block right here, wicked above it slightly, dropped, took out this low right here, didn't even have a pullback, just this imbalance didn't get filled until recently. And balance is kind of like this. We not only filled imbalance, pushed up into this order block right here. You can see we wicked above it, took out these highs over here, and now you can see right here is market open. We also have this area right here, marking midnight open, which is a wick below, or Judas swing below, and then we deliver to the upside. Okay, now we have the session open, which is from here. So we have this session open right here, and we've taken out these lows. We swept out the highs, took out these lows, and we created an imbalance. See what's the highest time frame what we can find. I like the cleanness of this one. You will notice as well, this is the range. This will mark the Judas swing. We've already tapped this order block right here, or this part right here, and the candlestick contributing to this is up here. A couple of split stops. We'll be targeting first low hanging fruit would be this kind of imbalance here. Ultimately though, I'll be trying to get to this, these equal lows down here. And what we're rating for right now, we've had the markers, the shift. This Fibonacci is showing the displacement range. We want to get entry in that premium up here, so we can get rid of this. This is just mark the session open to show that there's a Judas swing occurring. 9:30 is generally the aim of where you want to enter, but you can enter earlier. And you can see we took liquidity up here, which was these previous highs, and it was this imbalance, and we wicked above it. We then broke some market structure to the downside. Market opened, we're rallying upwards into this premium where we want to get our entries from, and it lines up with DXY being bullish into that kind of imbalance that we have up there. In AU right now, the so you could also maybe get an entry from here to here. This fair value gap is in the premium. We'll just be accounting this as we're getting a little bit late. We set my stop loss right here. Again, targeting this area. And again, this would be a low risk because we can potentially enter again. Plus, this is a very aggressive entry because of the fact that we are entering in a discount based off of this touch of the first fair value gap. We should expect though that price can reach this top one here, so we can account for that and then add our stop loss with spreads. We're gonna have to put it up here, so our entries come to this, and that's about 10 pips. AU, it's a sell, so just to get that down. So get into a sell right here, into the stop loss 72542. And then let's get the over here, put these down below, and then show this into the chat. So going over why we took this trade. So we started off with DXY, as we always do. We established that we're bullish, mainly because of this imbalance that we are heading towards, which we are yet to fill. So I believe DXY wants to do that. We've also had some equal lows down here that we've yet failed to achieve. We just created higher pushes after a higher push. So we're bullish on the daily on the USD. And here we've kind of just been consolidating. There's nothing crazy. So we're looking at price action, not price action, but I guess structure on the 1 hour time frame. We've been bearish for a while, but the most recent move was that we took out this buy side liquidity here, because this would have been above the order block, above the fair value gap. We wicked above it slightly, taking out sales, and then we had a market structure shift to the downside. When you're doing this type of trade, when there's not a clear direction, you want to be flexible, but also you want to aim for low hanging fruit, meaning that you don't want to, I know my target's down here, but I wouldn't set my target all the way to daily lows. For example, this low right here is within the range of yesterday's range. So yesterday's high, yesterday's low. We swept daily high of yesterday in this move. And normally when you take buy side, you aim for sell side. Sell side, you would obviously have yesterday's low right here, but I'm aiming for low hanging fruit. I'm going to be wary of this, however, because this is a fair value gap. We've come to midpoint, and that's what funded the push to take the buy side liquidity up here. So we have to be careful. With compounds, what I'd be looking for is bearish legs, such as this. This has already occurred. And then I'll be looking for things within this zone. So here, when we took this low, we had this kind of, we didn't, guess there's a fair value gap here. That's not really in the premium. This extreme to this extreme. And maybe just a re-entry on this touch. Nothing really, to be honest. So the first kind of area I'd be interested in will be around here. So I want to know when price gets here. If we were to close all of our trades at this level, it'll be a 1-to-1, which we may take out enough to cover if price was to hit stop loss, which would be about half. Because if we take out half of our contracts at this blue line, we're able to allow price to go back up and hit stop loss, or come to close the stop loss to then reach this goal if I believe that price would make it this far. So we reconvene. That's the point of the alert, to see what price is doing at this point in time. If price reverses our stop loss, we just accept that, because that's just a part of the move. And don't forget, this is from yesterday's range that we've classified that we're in a premium. So here we've not really got much, but yeah, that's the trade for today. Probably just gonna hold on to this and just watch it. We potentially could get re-entries above again, so I'm gonna add in more alerts when if price was to come up, we may get some more re-entries. There was a trade yesterday we took, then just about stopped us out. It's probably in this trade right here. It delivered perfectly here, but it came up and it didn't actually touch us out or stop us out, but because of spreads, it technically did. Anyway, so normally I would end stream, but today, because we got a very, very quick analysis done, I'm willing to move on and maybe watch a couple more episodes. We haven't been taking notes, mainly as we've come to the close of this kind of new area, but we can, at least I can, definitely put some things in place. Okay, so I'm going to be doing work on the side whilst I listen to the mentorship. Did it show correctly on the... I think it's on the split them. To swap them. Okay, good. For simplicity purposes, I'm just going to quickly check where we got up to.
All right, folks, welcome back. The continuing ICT 2022 free mentorship on YouTube.
Bear with me. What, wrong stream? $70 was yesterday. Yes, I think we did watch some yesterday. This was us back testing. So we've got the entry from.
So you're welcome to practice, but I'm not trying to hunt anything more this week because frankly, it can go either direction. It can go higher or lower based on that daily chart. So because I don't have a clear definitive.
So we did finish this, but I do want to go over this. So that's a bit clearer for me.
And I'm taking you into the E-mini S&P futures contract for June 2022. And I saw questions in previous videos where they're asking about June, and we're in the month of May. These contracts are delivered by contract month, so we're about to, in a couple weeks, end trading of June contract, and we'll roll over into September 2022 contract. But we have a couple weeks still trading June. Toss that in there for no extra charge. All right, so hourly chart. Obviously, we are looking at a swing low here to swing high, getting our range. Here's equilibrium. So the market did in fact drop down into a discount and a fair value gap. So we have a market that is in what? An oversold condition. Do we need an indicator to plot that or determine that? Nope, absolutely not. The rectangles are just to draw special attention for you, the viewer. The fib is just to highlight exactly where equilibrium is. Anything above that level would be considered premium. Anything below it, discount. So we moved from this high down into a fair value gap and below equilibrium, so we're in a discount. All right, here's the 5-minute chart. And notice that we had this run up in here. I mentioned in Twitter, and again, my Twitter feed is not a signal service, so that way we understand one another. But I was highlighting the idea that this was likely to go higher, and it needed to go for a premium relative to this high and that low. So we moved up into a premium, and then we slid aggressively, taking out relative equal lows. So below this low here, and here is what sell side liquidity. It was quick to do that right at the opening at 9:30. Short little bounce, then one more time below the low here, taking out sell side. For anyone that wanted to capture along here, they knocked them out. We had shift in market structure, and then rolled up even higher.
See, I had to. I hate how the alerts work sometimes. Right, so we're going to pull back into this area. Just trying to determine if it's worth a resell. It's going to be part of the accumulating of shorts. Okay, there we go. Again, if we come up.
Rebalancing all of this, drop back down into an area here where we have a 5-minute fair value gap. Trades down into it. I mentioned on Twitter that we would likely trade higher and take out the short-term high here and here. So I mentioned the morning high, that's this here. That was going to be the draw on liquidity, and we saw that run here, and actually went a little bit higher than I thought for the morning. Ultimately up into a fair value gap here for a really, really deep premium from low to high, trade up into that, and then pull back inside the range between this low and the high. So on a 1-minute chart, we're zoomed in here, and you can see in the morning I did a small trade here. I recorded this and did a small little vignette, shared it on Twitter. Took partials here at the time of posting the tweet, and then still no order getting hit here. Then the only other trade I had today was waiting for it to drop down to a discount, and when it did, I went long here. Had a little bit of heat here, not much. It was like 5 handles, so bearable. Stop loss was just below the swing low over here. So did it hit it? No. Did it look like it was going to? I don't know. I wasn't looking at the chart at the moment it happened. The trade here, I don't care, but it ended up coming back up, and I mentioned that we would run this high right here because we've taken out the sell stops here after running higher. So we had a shift in market structure back here earlier, and then we can basically consolidate and drop down to take out the sell stops. So anyone that was lucky enough to go long here and rode it up to here, the algorithm drops back down, clears the board, taking out the sell stops below here. I'm buying those sell stops. Had a little bit of heat here. We rallied, and I mentioned that we would start going higher now because we cleared out the sell stops. And going over into the 1-minute chart with a bit more detail. Here's the initial drop. Now, here's what I want to bring to your attention. We have a short-term little shift in market structure here. And I know some of you see this, and you see this one here. Which one's the shift in market structure? Well, I'm playing the run up here to a premium, like I was mentioning on my Twitter feed this morning. So if this is the range I'm working within, the shift in market structure occurs here when it takes out that high. Drops down into a fair value gap, which is what I thought. I didn't believe we were going to take out the lows here because we should have done it at 8:30 news.
I'll do what it's looking. Well, let me add more contracts anyway. But I think we'll just hold this. Might get a deeper pullback into this premium. Just keep learning.
It didn't do it. So this was a deep retracement and then sent it higher to go into a premium right before 9:30 a.m. And then they sank it down. Notice there's no model entry here. That's telling. Okay, it's tipping its hand to you. Because there's no real setup and it's a rush to get down here, it's clearing out sell side liquidity, going down, rallying, suckering in longs, trying to pick the bottom, knocking those individuals out. Now they're not allowed to be long. Their stop's taken. Nobody in retail usually will take a re-entry after something like that. They're afraid. It rallies up, comes down to a fair value gap, shift in market structure here, rallies, relative equal highs, drops back down in, fair value gap, order block, rallies once more, goes into the imbalance here, consolidates, bumps up just above the short-term high here, then drops one more time, clearing the liquidity out here. And you see my entry was at 41.20 on 5 contracts. And again, here is the tweet. Okay, and I'll have the link.
We should be expecting it to potentially push up to here. So happens we're getting right around that equilibrium mark. I will not be adding any more contracts or money, but just go trust the trade and let it ride and see what happens. I think my main weakness right now is direction.
Posted in the description below this video, so you can click and see it. It was time date stamped. That's exactly as you see it here. All right, so it says sell liquidity is taken, free to run to 41.43 and a half. That's this level here, while it was here. So continue on. First partial, this is when I tweeted. You can see that in the timeline this morning. 3 contracts were sold at 41.39 and a quarter, and finally the final 2 were filled on a limit order at 41.43 and 3/4. And ultimately it wrote a little bit higher, which was fine. I was juggling a lot of administrative tasks this morning, but nonetheless, you can see all the trades are here and here. So was it a lot? No, but hopefully you guys learned something today. We have a non-farm payroll scenario this week. It's first week of the month, transitioning from one month into another. And I typically like to have all my trading done by Wednesday. And because I've done what I've shown here today, I'm satisfied with this particular week. Now, some of you are going to be like, oh, this is crazy. You have Wednesday still, you have Thursday still, you have Friday. You're welcome to do that, but I have to be disciplined and being consistent. How you get there is having rules of engagement. So you're welcome to practice, but I'm not trying to hunt anything more this week because frankly, it can go either direction. It can go higher or lower based on that daily chart. So because I don't have a clear, definitive objective, I'm going to throw my hands and just be content with what I've shown you all here today. And that's going to be it for this week. I'm going to be finishing up with my private group. I have a lot of things I have to fulfill for them. And it means I'll be quiet on Twitter and I'll be quiet on YouTube until Thursday. I'll put another video up on Thursday evening. And until then, be safe. All right, folks, welcome back. Hope everyone's doing well. So we are in episode 37 of the continuing series of the ICT Mentorship for YouTube 2022. Here's our daily chart for the E-mini S&P June contract for 2020. And you can see we have worked inside this fair value gap. This is also a breaker. Okay, breakers are low, high, lower low. Find the high in between, extend it out in time. The market
trade. Okay, some more technical nice and this is where we're going to start paying attention. But more than we were before. Let's start this video again. Give me a second to do this.
All right, folks, welcome back. Hope everyone's doing well. So we are in episode 37 of the continuing series of the ICT Mentorship for YouTube 2022. Here's our daily chart for the E-mini S&P June contract for 2020. And you can see we have worked inside this fair value gap. This is also a breaker. Okay, breakers are low, high, lower low. Find the high in between, extend it out in time. The market trades down into that. It's also coming down in to fill in this fair value gap. So we came down, fill that in, and now we're starting to rally. Next spot of liquidity is this short-term high here. And then if we can get
I forgot there's news. It was positive.
some acceleration on the upside. We have relative equal highs up here in that fair value gap. Okay, so for the students here that are looking for a little bit more meat on the bone for bias, okay, when the market has moved from a low like this and starts to trade higher and creates a swing low, it's easy to assume that it might want to come back up to this high here. So notice how each day, with the exception of this one single day here, each day was bullish. Okay, so the bias would be expected to be bullish until we take out this high. It does that here. Then we have a day or two of retracement, which is logical because we created a fair value gap here. It trades down, fills it in once more, tests it, and rallies. So we're looking for tomorrow, which is Friday. Non-farm payroll is a day I do not advise anyone to actually try to speculate on. Now, there's going to be a group out there that have said, I've made money doing non-farm payroll trades. My reasoning for telling you not to trade is because you're here to learn how to read price action. So if I say, go out there and study non-farm payroll Friday price action, which can tend to be very volatile, choppy, or sometimes it becomes a dud. It doesn't do anything. But you don't have the experience to weather something that's very volatile and can be jarring to you. Okay, and if you're out here trying to gamble with live money, which is what none of you should be doing, if you're in here learning how to read price, that's why you're here, to learn how to read price. Months from now, if you come to the conclusion that you think you've done well enough on paper and then demo consistently, if you decide to go into live trading, you've done that on your own. I've done nothing to instigate that or try to get you to do it, okay? So bias is going to be derived from this chart here. Because we're likely to run this short-term high, that's what I'm thinking, I'm expecting that. It could happen overnight. There's nothing saying it's going to wait until tomorrow at 8:30 when non-farm payroll comes out. But if it doesn't run out this high tonight, at 8:30, if we're above the fair value gap high here, in other words, the candlestick's low here, if we're above that level at 8:30 and we have not taken out that high, I would expect price to try to make an attempt to get to that level. It doesn't need to go through it, but the bias would be I would expect that to be attempted. Okay. Now, does that mean go out and try to trade non-farm payroll tomorrow? No. A lot can happen from the time of this recording, which is a little bit before 9 o'clock Eastern time in the United States. So I'm not trying to trade non-farm payroll. Okay. I'm not instigating any interest for you to go out and do it tomorrow. But I do believe that you should study it. Try to determine what side of liquidity it's going to reach for before 8:30 news release. And when that volatility hits the marketplace, watch and see what it does on like a 1 and 5 minute chart. Get a feel for what it's doing. And it's an amazing study for liquidity purposes only. But unfortunately, sometimes these moves can appear, well, to the untrained eye, random. And then to the initiated here, sometimes the patterns that I'm teaching you and the logic materialize in the chart. And sometimes they do pan out to script, but not always. So the reason why I tell everyone to avoid like big days like FOMC and non-farm payroll weeks is because you don't have the experience and you can get hurt very quickly not knowing what you're doing. So I try to be responsible as a mentor, try to protect you from yourself because like I was when I was younger, it was very easy for me to fall into a trap or think I can do something I couldn't. So that way you understand. I try to teach my students to stop trading by the New York session on Wednesday. So if you had something that was profitable, quote unquote, up to that point, stop trading for the rest of the week. And then observe. Just study the price action the rest of the week, but don't try to push any buttons because you don't have any experience working in these sometimes very challenging market profiles. On the Thursday and Friday of non-farm payroll weeks, they can be choppy, they can be sporadic, they can come back against you when you really don't expect them to, and they lose a lot of their precision. Not all the time, but most of the time they lose their precision. So I want to be focusing on those days where I don't have those disadvantages, where everyone else is like, well, I got time to get in front of the charts, so let's gamble and it's casino time. And that's just not the way I do things. And I try to promote the idea of a sober mindset about what it is you're doing in respect to measure of risk. So be mindful of these levels here, the two blue lines here, and that red line here. It's a little bit lighter than these. You won't see these on the lower time frame, but this here is that short-term high here. And the two blue lines here are respective to that fair value gap on the daily chart. All right, hourly chart, E-mini S&P. Market trades down to the discount below the fair value gap. Again, these levels here are not drawn because of the basis of support and resistance on an hourly chart. Okay, these are the same levels that I drew on the daily, and when I change time frames from daily to hourly, they transpose to these levels here respectively. Okay, so the market trade down on Wednesday hits the fair value gap low, then we consolidate, and then we drop one more time to it here. Then we make a mad dash to take out the short-term high here. Do a shift in market structure. That's bullish. We take out the short-term high here and relative equal highs. And now we're gravitating towards what looks like a run on the buy side here. Now, it does not need to do that tomorrow. I could be wrong about that. I'm just saying that I think that this is the next draw on liquidity, so study that. That's all. Now, we do have a small little fair value gap in here. Be mindful of that. You might want to drop down into that before going up there. That's certainly something to study also. All right, on the 15-minute time frame, you can see here, this is the markup for the short-term high here on Wednesday's trading. We hit the fair value gap low on the daily chart. Went back, hung around in consolidation, rallied up. And I was in here trying to get a feel for what it wanted to do. I was thinking that I could capture a run to take the buy side out here. That's what I was aiming for initially, really early in the session. And this got chopped up a lot in here, and that's fine. I really don't care about that. But once I realized it wasn't trying to rally, I think we're going to try to take it once more below the New York midnight opening, which is this candle here. I want you to take a look at the way this day formed before I get into any more discussion about it. We opened here, consolidated, rallied up, and then dropped down into the fair value gap low on the daily chart and bounced there, rallied up, took out the short-term high here, and then kept on rallying and then closed here. This formation of price action is what I dub my ICT Power 3, where it's accumulating, manipulating, distributing. So it's opening, create the low of the day, and then rally. Now, if you see this pattern on a daily chart, it's easy to understand. But when you look at the lower time frames, it's easy to get lost in all the candlesticks and all the volatility and the movement and the quick fluctuations on these 1 minute and 5 minute charts. That's why the uninitiated would look at it and say it's noise. It's not noise, okay? It's doing what it does on the daily chart, just being represented on a smaller interval, like a 1 or 5 minute chart. So if you lose the context of, like, for instance, the levels here and here, you won't understand that it's dropping down to the higher time frame key level, which is the fair value gap low. Then market can rally higher. But once I got on the side, I shorted from in here and covered inside this candle as we were dipping below this short-term low. I forced myself to engage, not because I'm breaking rules, not because I'm undisciplined, but because I want to teach you why I avoid these days, because my precision drops precipitously. I don't have the visibility on these particular days that I do have on others. So if you have a built-in advantage, why would you go to an area or arena where you have built-in disadvantages? If you have advantages by trading on the days that don't create these type of conditions, you trade in those arenas in that time frame, and you avoid the times where historically your proven walk forward real trading results have been diminished on these particular days. So how many times do you have to have your flesh torn open and bleed out before you realize this is probably a time of the month where I shouldn't be doing anything, or lower my expectations in terms of the measure of precision? So over 30 years, that's what I've come to trust, and especially as a mentor teaching other people how to read price action, I really press upon my students to stop trading on Wednesday by the New York session. So if you haven't bagged anything by that time from Sunday's weekly opening until Wednesday's New York session begins, don't do any trades, and deal with that desire of wanting to trade, but don't do anything. That forges discipline. It forges patience. And also teaches you, especially when the weeks are really bad and it doesn't give you a whole lot of movement, you're going to be rewarded psychologically and emotionally because you didn't do anything. But on Twitter, I've coached those individuals there too, and I said, don't take any trades, don't do it. And today they did, and they regretted it. So some people decide to listen to me after the pain, but my whole point in doing these types of lessons and lectures is to try to spare you from all that. You don't have to go through the same things I did painfully to learn a lesson. So listen, okay, it's for your benefit. So anyway, I went short in here, and I shared that on a vignette, little tiny little video clip where you can see the business and the executions and such. But the afternoon, that setup, I want to go into that a little bit. And I didn't buy anything down here. I didn't do any of that turn here. I was actually shopping for some things that I need for the summer. So it took my attention away from being down here. But once I got back to the screens and I saw the market dropping down into this area here, I tweeted and I asked everyone on Twitter if they could find the 5 minute fair value gap above price. And I gave them a minute or two, and I shared the chart in case they were confused as to what it was being discussed. So my expectation was we were here and we were likely to drop into that in the PM session. So in other words, as we were going into lunch and on the other side of lunch, we could have easily traded up into this area as an upside objective. And then I didn't mention it, but you obviously know if we get above that, we'll be the next logical draw on liquidity, we'll be above this here. Okay. So on Twitter, if you want to go over to Twitter, you can see this is my handle. A lot of you guys keep asking. I've already mentioned it on several videos now, but it's the @ symbol, capital I underscore one time, AM underscore THE underscore ICT. I am the Inner Circle Trader, or I am the ICT. So you don't have to follow me on Twitter. I'm not looking for a lot of followers. I'm not trying to get everybody to follow me. In fact, you can just go to twitter.com/ and put this here in without the @ symbol, and you can look at my tweets. They're not protected, so that we don't have to join that platform. Okay, so I know there's a lot of people that simply will not join because all the politics associated with it. I get it, but we're there having fun, and hopefully, you guys can check it out and join the fun. If not, then that's cool. But it's a little bit more time friendly and easier to be alerted, unlike the community tab on my YouTube channel. I'm not really sure why sometimes people don't get notifications and sometimes they do. I don't know. So when you guys contact me or send me messages through TradingView or whatever, asking me those things, I don't know. Okay, I just put videos up or posts, and if you get them, you get them. If you don't, you have to go to the actual community post and see it. But Twitter obviously has always been my playground. I've enjoyed it in the past, and you can see here the time, 11:37 a.m. This is local time, Eastern time, and June 2nd, I asked everyone on E-mini S&P 5 minute chart, locate the fair value gap above market price. That's this one here. Okay, so I gave a little bit of time for folks to look for it themselves, and then I gave this here. Okay, so the market was trading right there, and draw on liquidity is here. Okay, so obviously you can see here, I tweeted shortly after that, it was bagged and tagged, was it was trading right into that level there. So the question is going to be, what's the purpose of that? What's the whole reason for me bringing it up? That's not a trade ICT. That's not a button being pushed. That's not an entry, a stop, and a target. Right. I'm teaching you by being your spotter. Sometimes I'll see things and I'll say, look at this or study that. For clarity, folks, that is not a trade signal. I'm not telling you to buy or sell anything. I'm trying to inspire you to look at price with the things I'm teaching you. Real time at that moment, before it actually develops and delivers in price, before your charts actually show it, I'm taking your attention to the right side of the marketplace. I'm pointing to a level I want you to study where we are at that time at market price, which is in this example here, and then study how it gets to that level. I'm sometimes going to be wrong, folks. Okay, admittedly, I'm going to do it wrong. Okay, but I want you to study from when I say take notice of something and study and see if it wants to deliver that by a specific time. Okay, I've noticed since I'll comment on something on Twitter, it's almost like it immediately runs to it. So that's also an interesting thing for me. I'm not sure what to make of that, but I know once I say something, it's really quick to be Johnny on the spot and get to where I'm pointing to. So I'll leave that up for you to decide if it's anything noteworthy behind that. All right, so this is a 2 minute chart. And before I even get into this is not a trade entry and this is not a trade exit. Okay, if you look at the shape of these arrows, okay, I'm not trying to defraud you. I'm not trying to fake something. I'm not trying to pretend I took this trade. Okay, I did not do it. I'm just showing you graphically. This is how you would have your chart. So if you want to journal things after the fact, what you want to do is you have your chart set up like this, and you have an order block, the down close candle prior to this move up here, and then we drop after consolidation into the fair value gap right there. Right here is where I tweeted. Look at this fair value gap. So price was here, goes in the middle of the tweet, and then up to here it delivers. So the pattern is this. Okay. So when you have that, you go back into your charts, you mark it up like this, and then over here you want to put down any observations. How long did it take before this move started to be delivered to the upside after it went into the fair value gap? Well, each one of these candles is 2 minutes, right? So it went into it here, so that's 4 minutes, then 6 minutes, and then starts delivering 6 minutes after hitting it. And it took 1, 2, 3, 4, 5, 6, 7, 8, 9, roughly 20 minutes to deliver that expectation and price. So it went from a discount. How's this discount? We moved from the low to here. Think about what's being shown. We are above the New York Midnight opening price. So the market dropped down to a discount, trading the low of the day. Now we're above this opening price, and we're going into lunch. Here is the New York session lunch hour. So we have time before 12 o'clock for this to potentially deliver, but I was giving it time to see if it wants to go there in the PM session, which will be on the other side of lunch, around 1 o'clock to 1:30, and then start to deliver that. But like I was mentioning moments ago, lately when I post or talk about anything, it's like it wants to get there right away. So again, make of it what you want. But after you have your annotations on your chart, you want to basically put down any observation that you notice, but you want to phrase it in such a way like you saw this in advance. So what happens is you're tricking your subconscious into believing that this is a experience that you really had. And it's like it's called self-talk. Okay, you're reassuring and reinforcing something that would be a positive thing for you. And while you may not have seen that trade and you didn't have the experience that I was showing on Twitter today before it happened, you borrow that experience for the study. But in your journaling, your chart would look like this, okay? And then you would fill in these little areas where it would draw on your observations, the things that you saw come to fruition, and never try to put anything negative in it. Don't say, I wish I saw this, or I was foolish and I didn't see this unfold, and I missed another trade, or I'm never gonna get this, this is frustrating. These journal entries are for you to reflect upon at a later time. And you want them to be positive. You want to basically cheerlead yourself in your journaling and keep things very fact-oriented. Everything is a matter of fact. And you want to phrase it like you saw it beforehand. And over time, how much time I don't know, but when you do this for weeks and months, maybe half a year or so, certainly by the first year of doing it, you will have tricked your brain into having all of this pseudo experience. The benefit of it is because you're logging the chart and making it look like this and retaining it and referring back to them each weekend, looking at the previous week, looking at the previous month, and just scrolling through your charts and reading your annotations. Yes, it's laborious. Yes, it takes time. Yes, it is boring in the beginning. But when you start learning to see these things form live, then you'll understand the benefit of having done it, because this is how you get it. Nothing else gives it to you. Watching my videos will not do it for you. You have to be in here doing this part. If you fail under my tutelage, it's because you don't do this. Okay? This is where everybody that fails starts their tailspin into failure. They don't want to do this stuff. They're like, I ain't doing that. I ain't got time for that. Well, then you don't want to succeed, because I'm telling you, there's no shortcut around it. You will do this or you will fail. Period. End of story. Have a nice day. Now notice what we have here. We have a short-term low here during the New York lunch hour. We're consolidating. The market drops back down and takes out that short-term low. We have unfinished business above that old high here. This is a stop run here, and it just slowly drifts up and takes that old high out. The only set
So one thing I'm learning is I need to stop. How do I word this? Separating the time frames from each other, as in the day and time on my computer is wrong. Wait. All right. Okay, I fixed it.
setup I liked was obviously the short and the re-entry in addition to the short I did, and you can see that on the vignette that I posted on Twitter. So I'm not going to bother the video down here with that. It's already in public. The afternoon session, or after the low is formed, notice there's no model entry for what I've taught you so far, but we have a nice fair value gap with the continuation to the upside with a fair value gap I was pointing out real time before it happened. So this would be the only other setup which I did not take. I didn't take this in a demo account. I didn't demonstrate it, but I did give you the logic to look for it real time in Twitter before it unfolded. So this is the framework that you would have in your journal, and everything I mentioned in this lecture tonight hopefully was insightful to you and helpful. And I will touch base with you again next Tuesday, Lord willing. Until I'll talk to you next time. Be safe. All right, folks, welcome back. Our continuing series on the 2022 free ICT mentorship on YouTube. We're looking at the E-mini S&P June contract for 2022 daily chart. All right, so I'm going to teach you a little bit about intraday profiles and daily range, and we're going to be using this idea here. So initially on Twitter, if you were following me on that platform, I mentioned how I was going to start the day looking for a potential run to 4070. Okay, so 4070 was my initial draw on liquidity to see if we want to reach down into that level. If you look in this area here, that's my fair value gap. You can see we traded down into it here. And today, one more time, we traded down into it, left these relative equal lows in place, and then started to move higher. I took everybody's attention to previous day's high and this high here. And if this continues to go higher, I mentioned this before, I can't recall what video, but I know I mentioned it in here. This is where we could potentially drop to for an intermediate term target or objective. But I'm not co-signing that just yet. Right here and here is enough. Okay, so we're expecting higher prices after the shift in intraday volatility. So we'll look at that now going to lower time frames. All right, here's the hourly chart. You can see how we did not take these relative equal lows out. I want to see it go down there. That's what I was looking for, to see it, try to draw down into that. It didn't do it. It did not give a setup either based on the model I'm teaching you. So I used the intraday volatility and the framework to kind of like teach it today a little bit more about bias, how to change gears with your bias, how to also manage your bias. Okay, so initially in the beginning of the morning, I was looking for a potential run to 4070. It gave an opportunity to tape read, quote unquote, paper trade, or even demo using the draw on liquidity, but the model itself didn't materialize. Okay, so because I'm the author of these concepts, I have a lot of tools at my disposal, and I have a little bit better understanding of price delivery than the average student of mine. So if I go in and I show you something in this lecture today, the main takeaways before I get into it is this: what did I do, and how do I go about abandoning a specific bias? How do I change gears if it is applicable? Sometimes it's not applicable to reverse. It just means move the sidelines and to say, I'm not going to do anything. And what are the characteristics that would lead to a bias that is changed, and how you use that logic going forward, and how to navigate the New York lunch hour. Okay, so we're going to tackle those topics in this video. All right, so notice that we had this low here taken with this run. Then this low was taken with this run.
Which low?
Taken with this run. Notice that we had, okay, so we're going to tackle those topics in this video. All right, so notice that we had this low here taken with this run. Then this low was taken with this run. And this low was taken with that run. So notice what we're seeing. We're seeing multiple lows get taken, and then the market reverses while offering really no high probability shorting opportunity. The 4070 level never got tagged, liquidity left in place. Okay. Previous day's high, which is here, that high was not traded to. So we have a high of 41.68 in the quarter, and then a fair value gap over here. So you have two premium arrays that may be a draw on liquidity. It takes something here and maybe even run above these relative equal highs. All right, on the 15-minute time frame, you can see how we just got going lower than the previous lows. And then finally, we had a run higher. So we had a short-term shift in market structure relative to the 15-minute time frame. Remember, that's our bellwether chart. So it runs higher, creates a fair value gap in here, and trades down into it here. Okay. One of the things I want to kind of bring to your attention, because a lot of you are familiar with a gentleman by the name of Chris Lori, and he talks about liquidity voids, where
are we going to get delivery, yay or nay?
he teaches how the market wants to come back down and fill all that area in. As you probably noticed, I don't teach that. I teach, obviously, there's times when that can occur, but because I understand the algorithm, that is not likely to occur most times. Okay, so it's important to know where the market's reaching for, and then look for these imbalances in price. And then what makes it a fair value gap is the fact that it's coming down into this area here, or inside this area here, or this area here, or this area here. So they're all fair value gaps. It's a fair value to buy it if you're bullish. Okay, I'm not trying to insist that these imbalances completely rebalance. That's one of the main differentiations between me and Chris Lori. Now, I'm not knocking Chris Lori, because I believe if you want to learn price action that's basic and goes beyond the average retail stuff, then you can learn from him. He's the only one I would give a nod to in technical analysis and as far as education. And I send people there all the time. I don't have a relationship with him on a business level. He doesn't give me any kickbacks. I don't ask for anything. I just think he's a genuinely nice guy. Okay, so there you go. But there is a stark contrast between what he does and what I do, and how I teach. So there's a degree of precision that is given to you when you understand the things I'm teaching you. It goes beyond simply imbalance, rebalance. While that is important, there are times when that is a factor. But what I'm teaching you is, where's the market likely to go to? Okay, I'm not trying to teach you entry patterns with a importance that getting in a specific price level is the most important factor. I'm teaching you how to determine where the market's likely to go to next. Where's that draw on liquidity? Now, there's a lot of different ways that is calculated on an institutional level. Okay, and how it's determined. It's not buying selling pressure. Okay, but it is algorithmic. So the easiest way for me to cut through all of the very complicated things that could very easily bog you down, and you may feel like the things I'm teaching are complicated. And I guess when you remove the idea of putting an indicator that says you're overbought or oversold, or a crossing over two lines that gives you a buy or sell, it's not, in my opinion, wisdom to exchange a decision, especially if you ever decide to do this with real money. It's not wise for you to determine your bet or your gamble or your investment on what an indicator is saying versus reading price action and getting the logic behind what it's doing. Okay, and that's narrative. What is narrative? Narrative is the understanding of what price should do, why, and what things will it encounter to prove that the narrative that you are assuming is in place is in fact underway. Now that's a mouthful. I'm sure most of you probably didn't get much out of that, but I'm going to break it down for you. I was looking for 4070 today to see if it can get down outside the range of that daily fair value gap, and we failed to do so, and then the market shifted higher. Now, the whole time I'm looking at the market, it's not giving me any kind of short. I'm not comfortable taking any kind of short, and all of a sudden the market does this. Okay, no panic, no I'm missing a move, no calling somebody else or reaching out to somebody on a social media platform and ask them, what do you think's happening? I don't worry about anybody else's opinion. You shouldn't worry about anybody else's opinion either. You're going to learn how to trust yourself. So we had created a fair value gap here on the 15-minute time frame. So right away, that is your area to watch and see if price supports a run. If it digs into that and starts to repel higher, and we take out this short-term high, that is enough to set up a stage for the afternoon trend. Okay, the afternoon session move or setup or price swing, that's what we're looking for now. Because the market failed to go to an objective we were looking for, it was respecting that daily fair value gap, and it rallied up. And what fair value gap is that? At the beginning of the video, I showed you on the daily chart. Here, it took out that short-term high, so now we have an absolute market structure shift. Bullish with this swing high, and the market comes back down in here and rebalances this fair value gap. Now, I'm not looking at, and this is where one of the instances where resistance broken, turning support, but it digs a little bit past that. Okay, notice that it goes down into my fair value gap, not stopping dead in its tracks right at the high. There's that. So I'm not looking at support and resistance. I'm looking at the fact that we went through the short-term high, created an imbalance, and then we traded down to that. And then when we get into this area here, I'm interested in looking at intermarket relationships. I want to study real accumulation and distribution. Okay, how do I do that? I've already told you. We're going to go into a lower time frame, 5-minute chart. All right, so here's the 5-minute chart. As you can see, the market did drop down. It did real quick sudden move after I tweeted saying that my initial interest was 40.70, and it started drawing lower. And then went one more time here at 10 after 9, took out that short-term low there, and then started rallying higher at 9:30's opening, and then we dig down into that 15-minute time frame fair value gap. So it doesn't look like a fair value gap in here. Notice that? But I want you to go back to your 15-minute chart. This is where the work is required on your part. In this price run from here to here on that 15-minute chart, look at your chart and shade that in on the 15-minute time frame, and then drop down into the 5-minute. You'll see how it drops into that shaded area. So we're working from a higher time frame, 15-minute bellwether chart, into a 5-minute chart. This is running.
That's exactly what I was saying earlier, that I need to work on not separating time frames. I feel like when I go from a daily to a hourly to a 15 to a 5, I kind of am analyzing it differently, whereas I should be taking my analysis time frame by time frame. So I start from the daily, I get a daily picture, and the daily may be that I have a 60% edge for bearishness, 40% edge for bullishness. Maybe I can find a couple of reasons for bullishness, but a lot more for bearishness. So it's more likely for price to be bearish. So I'm looking for the bearishness, but at the same time, I'm neutrally analyzing the markets. So when I'm analyzing the markets, I'm not only shading areas that will be, or analyzing it for sells. That's done when it comes time to enter, and the entry model takes care of that. For example, this model is what? Well, from midnight open around here, we had a fake swing, and we rallied to the upside, taking out this high, which is a daily high, and sweeping above it as such. We then had a market structure shift because price took out this short-term low here, also took out this low right here, this swing low right here. Once this swing low was taken out, you can see price really made that move. We then drew a fib. We want to look for the premium entry. Price retraced. We aim for the low-hanging fruit, which is this one here. We get a passive stop loss up here. We're aiming for liquidity. This yesterday's low right here. This is liquidity in between price, in the discount area, which price could use to push up again. But the point I'm making is that I'm utilizing multiple time frames to share or learn the same point. So what is it from the daily I'm using here? Well, show without. Okay, so this blue it's probably easy if I just hide it. So this blue candle here is today. So we opened at this level. We then pushed, took out yesterday's high, and we've come back down. But what do we know about manipulation? This is manipulation. It was manipulated. Price manipulated itself to take out this. But what's interesting is that the distance from the open to the top is the same as the same distance from the open to the bottom. So this whole candlestick here literally is either going to be a doji or it represents accumulation and manipulation together. Right. And then we zoom in to the hourly. What do we notice? We notice this high got taken out here. We notice that price also worked above this short-term high here. Right, price came above both of these highs. 1, 2 was taken out from midnight. We rallied up, taking it midnight, rallied up to take out these two things. What do you notice about midnight? It marks the beginning of the day, which is where we look at the power 3. So we've got in already that kind of manipulation. Okay, so after we've manipulated these highs, what do we notice? Well, the highs for reference are here, 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 and here. So use this, not this, sorry, here and here, right? These are the 2 places we mentioned on the hourly, which is here, here. So let me mark that out so I don't get confused myself. Hello? My vertical line. Of course. So here and here. So this high and this high, we've taken out from midnight. So midnight session took out this high and this high. Bam, gone. What happens afterwards? Well, we know we start looking for entries around 8:30, but afterwards we get this big dump here. So we draw that fib for our entry purposes, but we scale down. We then see this low get taken out, this low get taken out, with this one move, this low, all these lows get taken out. So we draw this fib, we see that this is the premium. We look for entries here, we enter here with our stop loss passive. Low hanging fruit, we're not aiming for. We're gonna watch what happens when price gets this sell side liquidity here. Gonna watch what happens when price gets this fair value gap. Watch what happens if we can see if we can make this. And we've compounded entries here so that we can then take some off as we go down, right? So my point that I'm making, which is I just explained kind of the process, but the point is that as price is, as I go from different time frames, from higher time frames to lower time frames, they're all saying the message, and I'm utilizing all of those to try and gain my edge, to try and gain, okay, daily said this, I'm using the daily high from yesterday, which is over here, to mark this. It's a daily low, daily high, that's the range. Manipulation to the daily high of yesterday, swept, pushed down, taking out all these sell sides, all these lows right here, pull back into this premium, we get our entry, set our stop loss from the entry model, targeting these lows right here. So yeah, we'll see what happens. And we can see that price is very volatile right now. And we also allow for the idea of price to push up into this kind of external fair value. Does that mean we'll make money? Maybe. We're also on the DXY targeting this imbalance on the 4 hourly. You can see here, this imbalance hasn't been taken out yet. So that's why we're bullish on the dollar, which lines up with sells on AU because the USD is the second part of the pair. So that's the reasonings behind. So that's why I'm saying that this is helpful because that's my weakness. I tend to alternate. I go to the 5-minute and I'm seeing a buy, but on the daily I'm seeing a sell. Hourly I'm seeing a mixed. 50 I'm seeing that. So I'm now confused because I'm not consistently tracking the same idea.
Running into that fair value gap. Now, if you're just staying on one time frame, or at least not carrying over higher time frame analysis into your lower time frame, you're gonna be trading blind. You have no idea what you're looking for.
Literally what I was saying, he literally says in the exact next sentence, you're going to be trading blind. Like I said, I literally just said I was confused because every time frame is saying a different thing because I wasn't sharing the same idea throughout.
Now I know what I'm looking for because I have multiple charts in front of me, multiple monitors, and I'm panning around. When I do my recordings like I did this morning, you can see that I actually executed the trade. You can see where I got in. You can see the actual executions. You can see the little arrows that show where I got in. I show the price, and you can see the partials along the way and the whole business. Okay, so if you're not following me on Twitter, you don't need to follow me. I'm not asking you to follow me, but you can go to Twitter and you can see that that is in fact shown to you there. Short little vignettes. I call them stingers. Okay, I do small little segments of me actually trading, or I'll do analysis or commentary without really saying anything, and I'll play music behind it because I'm having fun. I'm enjoying myself. Hopefully, you guys over on Twitter are having fun with me. If you're digging it and you're enjoying yourself on my Twitter feed, give me a heads up in the comments below. All right, so anyway, it digs down into that 15-minute time frame, fair value gap here, and then rallies higher. Then it starts to trail off and goes down into this imbalance right here. Now, in that little stinger video, I draw this little area out of the rectangle, and I do a small little box up here. Okay, and what that box is if it goes down into here and starts to rally, I'm going to take half that position off once it gets into this area here again. Okay, I don't need to go above this short-term high. So that's what that little red rectangle represents when you see me doing that stinger little vignette video on my Twitter feed. I'm drawing your attention here. So when we go from this level here, if it starts to rally up, once it gets back up in that area again, I'm going to take half the position off. and then see if it can run above that high. Okay, so that's what I was drawing to. I'm drawing reference to that, so that way when I talk to you tonight, because this is our Tuesday lecture, I'm showing you now what it is I was referring to and why it was there. Also, if you scroll back over here, you'll see it's an old area of buy-side liquidity here, and it's a fair value gap over there too. Okay, so that little rectangle here is drawing special attention to me, reminding myself that over here, there's buy-side liquidity that is not showing in that video that I'm recording, and an imbalance over here. So when it runs back up into that, this old area of buy-side liquidity, this might be just a stop run, and then one more time passing into that level. So I want to make sure I get half my position off, because I could be wrong. Like I was wrong about 40.70, didn't trade to it. Well, here at 10:35, right there, 10:35 right there, I tweeted, I said, note your previous day's high. Okay, previous day's high is here. So if we add the annotations back to the chart, and we'll remember that 41.68, and what price is that? 41.68 and a quarter. So that's our high that we're likely to draw to. That's what I was kind of drawing everyone's attention to. And I'll not add the annotations back. All right, so here is what I had in the recording. I shaded this area in here. It was like a shaded box. I just drew these really prominent lines here so that we can recall that's the fair value gap that I showed in that little vignette video. And I want to talk a little bit about New York lunch. Okay, I gave you rules of engagement when you're trading the afternoon session. And primarily what I gave you for the model was a morning session idea, but because of other people asking me and inquiring, hey, can you teach us a little bit about the PM session or the afternoon setup? I started bringing in some things. Now, if the market starts to go higher, okay, in other words, if we've been in a bullish market structure and order flow is bullish, that means everything's going in one direction, the market's obviously going higher on all time frames, then that's an easy trading scenario. But we're inside that little trading range area on the daily chart last few days, or a week or so. It's just been hanging around that smaller range. So you have to know what you're doing, or you're going to get caught up. So initially I wanted that 40.70 level. We failed to go outside the shaded area here. That's that daily fair value gap. So I've added it here for your notification. Notice that these lows here, this is lower than that one. Why is that important? Why am I drawing a distinction between those two? Well, if you go and you add your NASDAQ chart overlay, you'll see that this is a divergence. So even the S&P was relatively stronger than that of the NASDAQ. NASDAQ made a lower low here, okay? And I'll show you that before I close the lecture out. But for now, this is that 5-minute chart returning back into that 15-minute imbalance. So that's there for your notification as well. This is the opening price at midnight. That's what that level is. Now, I teach if we're bullish, we want to be buying at or close to the opening price, okay? Now, here's one of those advanced ICT things, okay? If you know that the market is likely to go down to go up, then you can wait for price to give you this type of setup right here, where it goes down, shift the market structure, come back down into a 15-minute time frame, fair value gap. This is intraday or day trading. It is not the model I gave you where it is a scalp. Essentially, that's what that is. The model I've provided for you for this YouTube channel is a scalping model. That's exactly what it is. But if you're going to day trade daily range, you're going to be using the 15 and 5-minute chart, and there it is. Now, you can use that model that I gave you for entries and scalping. You can use that as your entry criteria, but with the logic and narrative that you're going to trade in the daily range, okay? So if we're bullish, I teach and I've taught on this YouTube channel multiple times. My power free concept is if we're bullish, we're going to be looking for the opening price at midnight. It's going to drop down, create the low of the day. It's forming at 9:10, New York local time. It rallies up, shift the market structure. So it doesn't give me my objective, but it gives me these clues here. Now, the whole time I'm not tweeting to you. I'm studying price. I'm working with my son, and I'm measuring all these things. Because last word I gave on Twitter was I was looking for 40.70. No problem. No trade either. But I mentioned that
Wait, I'm not trying to think. Is it possible to predict from mint? So these are all the explanations I was giving earlier. Is it possible to predict the midnight? Is it possible to break from midnight to have this sweep? You had this break of market structure here. Fair value gap. We came into it once, twice, 3 times, then pushed to this daily high. Is it possible to know that beforehand? Because he was just saying how he used the market open? Because since the market opened, it basically rallied down to make this. To be fair, that's the same thing as price rallying up to then come down.
there was no setup, there's nothing going on, and the market rallies up. Okay, what I was looking for, it didn't reach it, and it didn't give me a setup. Did I lose any money? Did I take any kind of a painful ego twist of my arm? No. Was I wrong in the public eye? Well, some of you may think that because it didn't go to 40.70, but if I'm looking for something to deliver and it doesn't give me a setup, last time I checked, if you don't put a trade on, did you lose? No. If you put some skin in the race and you tell the public what you think's going to happen, it doesn't happen. Do you lose? Well, it depends on what your audience's mentality is. If they're looking for face value, yeah, I was wrong about 40.70. You hear that? ICT didn't get something he thought. 40.70 didn't print. No problem. I don't need to be right. The S&P divergence here in the higher low versus the lower low in NASDAQ comparably. And then we have the shift in market structure. We trade back down into the 15-minute fair value gap here, and then we rally once more. Once I saw that, then I'm good to go. I'm waiting for the afternoon setup. But now watch what's happening. The market rallies up, falls short of 41.40. That was another level I gave in that little stinger video on my Twitter feed. So I'm going to count you over and check that out. And then it drops down into the fair value gap. Starts to rally, but look what it does. It leaves these smooth, relative equal highs. And then does what? Drops once more below that short-term low. Now, think about what I've given you in your notes as it relates to trading the PM or afternoon session. If you're bullish, generally what will happen is the market has ran higher in the morning, then it consolidates into the lunch hour. Then after the lunch hour, it'll drop down and sweep the sell stop, score below some short-term low where the lows meet in lunch. Okay? Now watch what this does here. It creates a low ahead of the lunch hour at noon. then it drops down into the fair value gap. Is that not doing what I gave you in terms of the rules of what liquidity is doing in the afternoon, post New York lunch, when we're bullish? Yes. What's different? It's not consolidating. See that? Is this a consolidation? No, it's a retracement. So if you can identify an area where it's likely to retrace, and some of you asked on the Twitter feed, why am I measuring from here to get this versus this here to here? Well, you have to ring in what I'm trying to do. I'm trading the daily range. I'm trying to get the majority of the lion's portion of the daily range. So because I'm doing that, I'm factoring in that midnight opening price. So we went above it here and once more. So I'm not expecting it to go back down below here again. So to refer to this low now, again, is pointless. I'm going to use this one here for market structure. So market structure, swing low here to swing high, that's my dealing range. So that's why I outlined that one here. Okay. And I'll give you a small little rectangle here, draw my attention in the video here to go back to what I mentioned moments ago. That's an old imbalance. It may stall here. It may fail here. It may just consolidate and then run for previous day's high, on Wednesday. So I'm going to take half my trade off, which is basically what you saw me do. But anyway, it's taking out that short-term low on a retracement. But if it was consolidating into lunch, I would look for the swing lows during the lunch hour and then wait for the drop down, sweep them like it's doing here, and then round it. Because this is a retracement going into lunch, that to me, it signals that they're going to work through lunch. What does that mean? Years ago, when we were on the floor only, open outcry, sometimes the floor traders would know that the market was in a hurry. It's a fast market. So they're not going off the floor. They're going to stay busy on the floor and they're trading. So I learned this from actual floor traders. So I'm not making it up. I'm not, listening, just giving you some kind of garbage made up or some contrived nonsense. It's based on what they used to do. And that same mentality has been transferred into electronic trading. So the algorithm does that same thing here. During the lunch hour, if it's a fast market, it's retracing back down into a random fair value gap. It creates a short-term low, and then it runs the only short-term low that's there from here to here. This is too narrow. We don't want that. It's already moved too much. And it's going into that hour ahead of lunchtime, noon to 1, near total time. So I want to see it retrace back down to a discount. How's that done from that low to high? So the algorithm reprices to a discount once it gets to here. Then it does what? Creates that short-term low, rises a little bit, leaves smooth highs in here. So what is that? They think that is resistance. So anyone that's short, they try to stop loss here. And then drops one more time, break below that short-term low. What's below that short-term low? I already told you here. Sell stops. So I'm thinking, like smart money, this is going to go higher in the afternoon. I didn't take anything in here in the morning, and I was not correct in where I thought it could reach for, which is 4070. If it went to 4070, you know what I would have done? Said, there's your 4070. And you would have asked, did you take a trade? Or the cynics would have said, but you didn't take a trade. That's not what I'm trying to teach you. I'm not trying to teach you entries. I'm teaching you the logic on how to read the markets that way. Once you get this skill set down, the entries are the easiest thing to do. That's the easiest thing to do. But you have to know how to read the market and also tell when the market's turning. If it's turning, where's it going to go? And if it's going to go higher, where will setups form? I showed you that today. Right on Twitter. Right there in front of everybody. Now, the market drops down into the sell stops here, and it's inside that fair value gap. And it's happening in the lunch hour. Now, I had things I take care of, and I was going to be away from the screens as I was. And I didn't think I'd be back before 2 o'clock. But I was managing that trade from my cell phone. And you can see that cell phone trade management in the short little vignette. You can see the stops being raised, and I'm taking partials along the way, the whole business. But as it's going up into this area here, I'm taking some of the contracts off. And I'm raising the stop loss up. Because I don't want to come back down to that fair value gap again. Because we've done this once, twice. It should never come back down that again. If it does, I'm wrong. And I don't want to be a part of that trade if I'm in a position that's still open or have a partial open from the original position after partials open.
I'll tell you this. This has come up into this once. This is even in the fair value gap. This is in this one. I wonder how you'd manage this.
Taken, then I'm going to kill the trade. And I'll move to the sidelines. But the main thing I want you to understand about this is I'm not trading the model that I'm teaching on YouTube. And you're probably going to say, well, why don't you just trade the model, Michael? Why don't you just teach us how to use the model? I am. When the model speaks, I'm going to show you. But I'm also teaching you how you still learn to reprice when the model isn't giving you a setup. Because every single market isn't going to give you that model's entry, setup, and framework every single day, every single session. And because I'm the author of these concepts, I don't have a limitation to just that one. So is it beneficial for you to have me say nothing when the model says nothing? Or is it beneficial for me to teach you how to reprice action, how to get in sync and learn how to change gears when the market shows you it's time to change gears? I think that's a little bit better expectation on the part of a student with that of a mentor that has the experience I'm trying to share with you. So there's 2 camps that's going to be looking at this video, and they're going to say, he's not really a good teacher because he's not focusing on the model. When I'm telling you the model didn't do anything today in this index. So what did I lean on? My experience, my ability, and the concepts that are already taught in this YouTube channel. So one of the Twitter followers I mentioned today that can they use time frames outside of the 1 through 5 minute chart, but use the same logic? Yes. That's all I'm trying to do. I'm trying to teach you a mindset that on the lowest time frame, it gives you a lot of experience, a lot of setups, a lot of things to practice. But don't limit yourself to that because there's so many other ways to trade using what I'm teaching you. You can scale to whatever time frame, whatever chart you want to use it on. Okay, but you still have to understand what price is likely to do and where's it drawing to. Okay, so let's talk a little bit about narrative. When the market shifted here bullishly and it came back down into that 50-minute time frame fair value gap and then rallied, this right here told me that they want to set this up for a bullish run in the afternoon. Why? Go back to that daily chart. Remember, we were inside this shaded area here. That's the fair value gap. I did not shade when we were looking at the daily chart naked at the beginning of the video. If you shade that on your own chart, you'll see when you drop down to the lower time frame 5-minute chart, yours will look like this. So it dips down into that lower end of that fair value gap and it rallies, trades back down to the 15-minute time frame fair value gap, which is what that is here. And then it rallies. Now, right away in my mind, this tells me that the algorithm is priming itself for an afternoon run to potentially previous day's high, which is this level up here. Okay. So from here, right when it crossed over here, I'm thinking, okay, it could potentially run previous day's high. I don't know it yet. Then when it drops down into here and then rallies from that, then I know it. Now that's narrative. Okay. By itself, it doesn't mean going in and buy because, hey, the narrative says it's going to probably run to previous day's high because I could see myself stop down if I'm premature. I want to see something that makes sense logically. So that means, do we see displacement? Yeah, we do. Is that an energetic price run? Oh, yeah, it is. Then that low to that high, I'm going to get that measurement for premium to discount. And what do I want to wait for? A discount. So I measured from that low to that high in that short little vignette video on my Twitter feed, and 50% and went below that, and that's the fair value gap. So it trades down into here, creates a short-term low, and then drops into here. Now, what happens if it went here and rallied? Okay, well, I missed a move. But I'm looking for sell-side liquidity. I want to see a stop run because what that's doing and how this fits into the narrative is if I'm thinking that this move here to here and retracing down and setting up an afternoon run to potentially this level here by the close of the day, I want to be like smart money and do what? Buy sell stops. That is buying sell side liquidity. My order, as it's underneath here, I fill right here. I'm buying it on this candle right there. I know you probably don't believe me. I'm going to show candlesticks in a minute. But I drop down into it, I go long there, and then I wait for it to rally up. So it starts to rally up, and it consolidates a little bit in here, and then starts to almost come out above this high, and it creates a little small consolidation, and then pumps it through the old high and the 4140 level. Creates a short-term high, rallies once more. I draw a line on here because I want to see if price can be supported by that down close candle. That's a order block. It trades through it, and once it did that, I mixed the trade. Okay, I have taken a lot of the trade off through here, and I'm also in an environment still inside that daily range of multiple days on the daily chart where it might not go to previous day's high today. So this might be it, and it might need to use Wednesday's trade. So that was my thought process for closing the trade and protecting my stop loss, which never would have been hit because the stop loss was low here. But it came down, closed in this fair value gap, a rally again. This is an optimal trade entry once more, pushing higher, but still did not hit the previous day's high. Now think about this, folks. Think. At the beginning of the day, I tweeted public knowledge. I want to see initially if it wants to make a run down to 4070. Okay, and as soon as I tweeted it, it was like off to the races it goes. Right in here, boom, and then drifted down to it here and made a low of 40.76 even. Didn't break out below the fair value gap that's formed on the daily chart. That's again that shaded area here. And I have this tweet here, so you can see at the time 10:35. So I said note yesterday's high. So that is there on this candle. Right here, 10:35. I'm tweeting note previous day's high. So I'm drawing your attention up here. So if a retracement comes back down into what I shared in a video beforehand, before it even came down here, I'm showing you this. And I gave you this level up here as previous day's high in chart format in the video, showing you that this is where my mindset is. I'm thinking, think up here. This is where it's going to draw to likely, and it's going to retrace down to this level here. So right away, this should tell you that for the folks that are paying attention, ICT says that it's probably going to go up in the afternoon. And it's probably going to gravitate towards this level up here, which is previous day's high. And he's showing this level here, where he's taught optimal trade entry, fair value gap. When it goes down to here, it's in what? A discount. So we're moving from a discount to buy sell liquidity. So the premium array is up here, the discount array is here. Doesn't it make sense for you to anticipate the move originating basically from here, running above here, taking a partial, and seeing if it can gravitate towards the high? Yes. So you study that way. So that's what I do with my students in my private group. That's what I'm doing with you. Okay, folks, listen. I've had thousands of emails come to me in the last couple months asking to let you all in my private group. My private group is done. I don't even make videos for them anymore. Okay, we just chit chat on forum now. That's all it is. I'm teaching mentorship right here for free. You don't have to have a PayPal account. You don't have to give me a credit card number. You don't have to worry about missing your payment. Nothing. All you have to do is show up every time I do this, or show up over on Twitter. See what I'm doing over there. And I promise you, if you stick with it, the things I'm teaching you work. They I absolutely use this logic today. I didn't create something new today. This is exactly what I'm teaching you. As a mentorship, this is it. I did the very thing I'm teaching you with, so that we can see a button was pushed. Do I need to put a trade on every single day to teach you? No. Will I continue to show trades? Yes. Will you be accepted in my private group? No. So please don't ask. Okay, that community is closed to them, and you are all benefiting. And believe me, they're learning along with you with this mentorship. Paid members that went through my private group, they're learning things just like you are right here, because I'm taking things and simplifying them. If I let you all into that group and took all of your money, you would all be confused. Okay, because there's so many things. It's very, very detailed. I have simplified it here. That's all I've done. I've made it very simple so that we can go in, look at these things, and make it applicable, because you need to learn how to do this before it gets hard. And it's going to get real hard, folks. Read between the lines and think about what I'm saying. Look around. The world's changing. Okay, so put in the time. Don't rush it. You don't need to worry about taking a year to learn how to do this. I've streamlined this. Okay, I'm here. Until the good Lord takes me or takes away my mental faculties, I'm on YouTube, okay? I'm on Twitter. I love doing this. I love being back in this capacity. I'm free to do what I want to do. I'm enjoying myself. And all of you, both private membership and public mentorship, you're all benefiting from it. And I'm having fun with you. So don't mess it all up by stressing me out, asking me to join a group that I'm not going to let you join anyway. And I don't want your money, so stop asking me. So anyway, this is where we're at right now. I think we're probably going to sleep up here. Maybe that might happen tonight during the Asian session. But let's take a look at the executions. And on this candle here, the low on this candle, look at this figure right here, okay? That low is 41.11 even. And the low on this candle comes in at 41.08 and a quarter. And my fill, 41.10 and a quarter below that low. Oops, I'm sorry, I'm doing the wrong one. The low is 41.10 and a half, and then my candle entry was here. The low was 41.08 and a quarter, and my fill was still below that. It's 41.10 and a quarter, so 1 quarter point below that. Okay, so there's the entry right there, and then partial here, and another partial there. So half the position took off 10 contracts on this price and took off half in that area where that rectangle was drawn in that little vignette video. Okay, again, I'm doing this, folks. Go back over here. See this area over here, and these are all equal highs. I'm thinking that it could do this, and maybe this might be a failure swing, right? And then go lower. So I'm taking off half in the event I'm possibly wrong. So that's why I did that. And you understand that? And I took another partial here. I tweeted, pay the trader. Okay, so 3 contracts there at 41.34 and a half. And then I waited for it to pump up through this old high and the 41.40 level at 41.41 and a half. I was like 3 seconds late. I was waiting for it to give me a nice big candle. And if you watch the vignette video I sell the one contract, and it gives a little bit of a ramped up expansion on the candles. I'm like, I just would have waited one more moment. It could have given me a better fill, whatever. And then here's me closing the remaining one contract because I was concerned it was going to take the stop, and I didn't want the stop out. I'd rather take my price at my own exit and not let the stop out occur. But it never would have hit here and just rebalance that, and then that old high around again. But still failed to get to my objective on the day. But this was the draw on liquidity. Now think about what I was showing here. I was wrong on this level, and I was wrong on the 40.70 level. But I was able to trade and take the lion's portion of the move in the middle. That's all you need. You don't need to be in here doing the absolute highest high and the lowest low. You don't need to do that. Okay? The folks are asking me, can you teach me to do that? You don't need to. Look at this. Wouldn't this keep you from going hungry? I mean, I think it would. I mean, this is good eating here. I mean, this is a nice move. It makes sense. And I don't need this level to get profitable. Old high? Yes, yes, and yes. Okay? So I mentioned I'm doing into the S&P versions in here, so I'll do that now. All right, so I'm adding the little compare tab. It's a little plus symbol up here. If you go into your trading view, click on it, it'll give you the drop down menu for what instrument or market you want to compare it to, and use NQM2022. This is going to change to NQU2022, and this symbol for S&P will eventually, in a few days, change to ESU2022, and it will be basically tracking the September delivery contract of both indices. Right now, we're in the month of June, and it's about to roll over. So what we do is we monitor barchart.com, and whenever the open interest is larger in the September contract than that of the June contract, that's when I roll over. So that's how I do it. It's a little different from everybody else, I'm sure, but that's what it is I'm doing when I'm rolling over into the next month, because these months or these contracts they expire. Okay, so June won't be traded anymore in a couple days, and September will, and we'll trade September until a week or so into September, and then we'll roll over to the December contract because September will expire. All right, so anyway, with the compare tab, you're putting in this symbol here as a selection in the drop-down menu, and once it's down here, you put on a little gear and make sure it's highlighted to low. Because what we're doing is we're comparing and contrasting the lows inside of a fair value gap after a retracement into a discount, and we're expecting to potentially trade up in here. I'm speaking like you knew this. Okay, that's how you're supposed to talk to yourself in your journal. This low versus this low. See that lower low? Is that seen here? Low, higher low. We're comparing lows. So when we're bullish, we're plotting this line down here as a compare and contrast tool. And it's SMT, smart money tool, or smart money technique. I never really settled on what the T was going to be, so that's why I always say it like that. But it's my way of measuring real accumulation distribution. So if we know that this area down here is a discount, and we know this is an imbalance, fair value gap that trades down into a pool of liquidity below that low sell stops, and I want to buy sell stops, like I mentioned here, I'm buying the sell stops inside the fair value gap during a classic buy day, which is open at midnight, trade down, create the low of the day, rally, and then creates an optimal trade entry or fair value gap, or you're going to buy the short-term low during S&P divergence. Okay, so there's real accumulation here between the NASDAQ and S&P. So this tells me that the NASDAQ is going to go lower, so it's under accumulation, and this is just a stop hunt below that short-term low. See that? Now, some of you are like, this is really complicated, ICT. I really like optimal trade entry, and these fair value gaps are all over the place. How do I know which one's the one I want to use? Okay, check this out. A lot of you know how to use optimal trade entry. You'll use the low here, the high, pull your fib up, 62 to 7% trace level. If it goes down to that, then you'll buy it. Okay, that's one pattern. But now watch what else there is. This is turtle suit. You have a low, lower low, buy the low that's being violated with optimal trade entry. See that? Or you can just do this. Low, high, find the fair value gap below 50% level, which is a discount. As soon as it trades to the top level of it, hit it there, buy it there, stop below the lower low. Or low here. There's your pattern. See that? Or you can do this. You can wait for it to trade down into this like that and find the swing high prior to it trading into the fair value gap and put a buy stop there as your entry. And whatever the lowest low is after it hits that, that's where your stop loss would be, just right below that. And you can be buying strength. That's not, in my opinion, the preferred entry strategy, but I'll just give you a bunch of them. But it's using what? Bias that has been corrected and calibrated based on what the market has done here at key times. Okay, so at 9:30 the market does what? It brings us that volatility we look for. So it shifts higher after we have another S&P divergence here. But we have that shift higher. It's showing us real accumulation in the S&P. It rallies. I don't want to chase that. I wait for it to come back down to the 50-minute time frame. Fair value gap, which it does. Now, am I still buying it? I absolutely could do that, but I'm not willing to because I want to know that what I thought initially, which was 40.70, it can still wipe out that low. It's early on in the day. So I'm going to wait for the market to really communicate to me that the algorithm is pricing in a narrative that the afternoon session is bullish. That's it. I'm going to give up the morning session, folks. See, just because I'm sitting in front of charts doesn't mean I'm taking a trade because guess what? I'm going to take a trade because I've been here all day and I deserve one. It doesn't work like that. You have to wait and be patient. There's more time waiting in between the setups than actually doing anything. And then it's funny. You have to have incredible patience in both stages. You have to be very patient waiting for the setup. And then once you get in a trade, you have to be patient and let the trade pan out. Once it comes in the 50-minute time frame here, then it rallies like this, then I'm comfortable knowing what I'm looking for. What is that? Dealing range low, dealing range high, fib across it, 50% below that. Here's a fair value gap, trade down into it. I want to buy sell stops. That's just me. I want to do it because it really fortifies the setup. It allows me to get in where the smart money will be buying. That little movement here, I'm buying that very candle. I didn't buy the next candle. I didn't buy the candle before that. I bought below that price, 41.10 and a half. I bought it at 41.10 and a quarter. The things I'm teaching you, I'm pushing a button. It's a really real instance of happening, not something I took a trade and you never see that happening. Okay, I'm showing you example after example after example of the things I'm teaching you, and I'm using the logic. I'm not creating some falsehood. I'm not scamming you. I'm not frauding you. I'm not doing anything except for teaching you what works, what makes these markets book, and they do it every single week. The same kind of stuff all the time. S&P divergence here. You see that? S&P divergence here. Lower low, higher low. Here we have the lower low in NASDAQ, higher low in S&P. That sets the stage for that run higher. Okay. I can literally go on and on for about 4 more hours just in this chart, but I promised myself I wouldn't make these videos very long, and then some of you really want those long ones back. But I look at the statistics on my videos, and the attention span's about 10 minutes each video. So I'm going to try my best to stay in that vicinity. Can't promise, but I'm certainly going to do it as much as I can, and I'm certainly obviously well beyond that limitation here. But I know a lot of you press that 2 times the speed function on the videos, and I get it. If you ever listen to me in a forced live session, I sound like a different guy, don't I? That's because I don't have that sped up chipmunk sound that you guys usually put me on. But that's cool. I understand. Everybody's time's important. Hopefully you found something in this insightful. Hopefully you're encouraged by me actually showing it working and not just talking about something theoretically. And again, be safe, and I'll touch base with you again on Twitter.
So 2 things there. I put him 2 times speed because I can hear him clearly, even if it's at 2x. Number 2, I was very surprised. I read a comment where someone said it was about 10 minutes that people were listening to, which is crazy. So I was doing numbers about like 10%, but the average is 10 minutes. People are really not watching all of this. Is what it is. I mean, we're on to the next episode. I'm going to end the stream here. Currently, we are in this trade. We're going to let it pan out. We just added some more funds to the spread. We haven't entered any more, not for spread, for, what's the thing called? Where, like, margin call. But other than that, this is our target. This is our low-hanging fruit target, which is in this fair value gap. The sell-side liquidity in that zone. This is our ultimate target. And it's a 1 to 3. Stop loss is about here. Let's see what happens. So comfortable, but for me, I'm comfortable in any trade as long as everything before it is good. The entry is good. We had a sweep of this. Yesterday's high. Market structure shifted downside. Displacement. We're in that optimal trade entry kind of area. We're selling towards the equal lows down here. Equal lows down here. It's first target with the alert set. I've got my phone by me. I'm good. And I'm happy with this. So I'm willing to end there. We're not taking notes for the next couple of episodes because we're going to kind of vamp the structure of this. And the way we're going to revamp it is rather than organize it by episodes, I'm going to organize it by topics, so I can actually, because it's difficult to, if I want to look for specific information, I have to find the episode before I find it, and then sometimes it's when he introduces it in episode 12, he may expand on it in episode 24, so it's a bit difficult. So I'm going to reframe it in a way so that it's a bit clearer, but it's going to be a bit more difficult, and it will take a lot of time to do. So I'm just going to listen and try to take, and you'll see me go into the charts to try to see what he's talking about. That's kind of my learning right now. And then after a while, I should already know by now, my journal will have a study journal, and that's where I want to put it. The study journal will showcase me learning it, and it will have everything in kind of in line with what I want. And yeah, I think it'll be pretty cool. But I still need to update this as I go along as well. So that's what I'm doing daily, and we'll continue. We're going to let this trade play out, and I'll see how it happens. Is I'm going to hit my stop loss or my targets. I'm not set closing early, nor am I adding anything extra. So it's been your boy CJSC, and I'll see you guys tomorrow. Peace.